Hello friends, welcome to my YouTube channel Sachin Education Hub in English. Friends, today we will discuss the two major important topics. One, what is the scope of corporate finance? And secondly, discuss the major modern classifications of the corporate finance. So these are the two main important topics every time for the exam. So coming to the very first topic, what is the scope or the objectives of the corporate finance? When we talk about the objective, it means corporate finance means the finance that is actually need by the companies, right? So first objective is why the company need finance, just because of the maximization of the shareholders value, because shareholders are the main part of the company. So there should be a maximization of the shareholders value every time because of their satisfaction and because of their higher returns. How can it be achieved? So company can achieve this success through various strategies such as investing in the profitable projects, optimizing the capital structure, or improving the various operational efficiencies. It means by using various strategies like these, company can company can have a main objective, that means maximizing the shareholder value can be achieved very easily. So first objective of the every company for the purpose of corporate finance is to increase the shareholders wealth. Secondly, long term financial planning. Every corporate wants to live longer, every corporate wants to survive for a long time in the market. So similarly, corporate finance main objective is to help the companies in long term financial planning, and it can involve various types of planning such as forecasting about the future cash flows, estimating the cost of capital, or setting the various financial targets for the purpose of long term period and achieve the maximum success in the company. So these are the major financial objectives that every company have, and these are the major financial objectives that are achieved with the help of corporate finance in the companies, right? So this is the second main objective. Coming to the third main objective is, that means investment decision, or you can say, sorry, capital structure. Capital structure is the third one. Capital structure is the third one main objective that come under the corporate finance is capital. What is a capital structure? Capital structure means a group of strategies. It means you can say I have a company have an equity of 70% and the 30% of the debt. It means company have 100% of capital structure with the composition of equity and a debt. Whatever the sources, the combination or the total proportion of these sources is considered as the capital structure, or the finance from these sources, and the combination of the finance from all these sources as a sum up is called as capital structure. Say an example, I have an equity of 50 lakh, sorry, company have an equity of 50 lakh, company have a debentures of 30 lakh, and company have a retained earnings of 20 lakh. So it means composition will be consist of all these three things, and these composition is considered as capital structure. So corporate finance is actually need for the purpose of optimal capital structure, because the balance between the equity and the debt is the main part of every corporate. Whatever the balance between these two things will help the company to be live longer and get the easy finance. Okay. So coming to the fourth one is the investment decision. Whatever the company objectives have, investment decision is also the very important objective. Corporate finance involves the investment decision that includes the investment in various types of project that gives higher return for the company. Investment decision also consider the various risk and return. So corporate finance always have an objective to decide where to invest, how to invest, so that company can grow easily and get higher returns in the future for the purpose of shareholders wealth, right? Coming to the fifth one is risk management. Corporate finance also assess or manage the various types of risk that are specially related to the finance. What type of risk? That includes what type of financial risk? It will be include interest rate risk, it includes currency risk, it includes market risk. So all these types of financial risk are easily managed by corporate finance. So corporate finance always have an objective to manage the risk, to assess the risk timely so that company can easily assess these risks for the purpose of adapting the changing environment and overcome these risks with the help of corporate finance. Okay, so these are the main five objectives that have every company have while going to the corporate finance, while deciding the source of corporate finance to get the higher returns in the future. These are the objectives. So after completing the source scope or the objectives of the corporate finance, coming to the modern classification of corporate finance. Modern classification of corporate finance consisting of two types. One is debt financing and the other one is equity financing. Firstly, coming to the debt financing. Debt financing means the borrowing the funds from the external sources. Means banks, financial institution or the bondholders. If the company raising the finance from these type of external sources, then it will be considered as debt financing for the company. So what will be included in this type of debt financing? It will include bank loans. Firstly, the bank loans. Company can easily can raise the loan from the banks, right? And the bank also have always ready to giving the loans to the company for the purpose to run their operations easily or to invest in the many projects if the company wants, because there are a lot of projects today that company wants to invest starting to run their business, but they can't. So if the company wants to invest in this project and get higher returns, or the company wants to run their operations smoothly from the starting of the business, then the company can easily raise the finance through the purpose of bank loan from the various types of banks. So this is the first one. Secondly, bonds. Second one is bonds. This is also the source for the this is also the source of finance for the company. Company can easily issue the bonds to the investors for the purpose of raising the capital. As you know, bonds are the debt security and paying the periodic interest payments to the bondholder after while repaying the principal amount at a maturity, right? But after repaying the principal amount at the maturity or giving the interest on the principal amount, no matter this is a higher cost for the companies, but it will also giving the huge amount of money to the company for raising the finance from this source, and as well as to running their operations in a smooth way. So this is the second type of source for the every type of companies. Third one is line of credit. Company can also obtain the line of credit from the various types of banks or other financial institution, or you can say the banks have a short term credit, or the other financial institutions have a short term credit that are funded by the companies for the purpose of short term short term financing or the purpose of short term growth of the business. No matter, companies are always focused on the long term planning or the long term objectives, but sometimes company wants to reach the higher position just starting from the after just starting from the short point. You can say that if the company wants to give the higher returns for the purpose of long term, sometimes company can go to the long point just after completing the short financial objectives. So this is also the major source for the company if the company wants to grow for the longer period and raising the finance easily. Coming to the fourth one. Fourth one means leasing. Leasing. It means company have various types of lease equipments. Various companies have real estates. Various company have that type of assets that give high return to the company if the company giving these assets or real estate or these equipment on the lease. Because by giving these assets on the lease, company can also raising the finance for the purpose of very huge period of time, and this will giving the huge finance for the company to run their operations, to invest in various projects, and running for the longer period of time as well. So this is the fourth debt financing source for the company if the company wants. to raise the finance from this source. Now, after completing the debt finance, second one is equity finance. Equity finance means selling of the ownership. You can say if this is the source for the company in today's scenario is a very much uh, you can say very much familiar for the every type of investor, right? So you can say that selling of the ownership interest of the company is considered as equity financing. If the company wants to sell few part of the company's ownership interest to the various investors, so that the company can earn huge amount from this source of finance, then this source of finance is considered as equity finance. What will be included in this type of finance? Firstly, the common stock. It means a share. It means a share. What is the face value of share? Usually every share have a rupees 10, face value rupees 10, nominal value rupees 10. So you can consider that if the one share rupees 10 and number of shares are bought by the investor, then it will give the company a huge amount of finance for the purpose of longer period of time as well. So you can say that common stock is the best type of source of finance for every company to raise the capital from the investors. Or you can say common stock representing the ownership of the company, as you know. But after giving the ownership to the of the company to the various investors, company can also raising the huge type of finance from this source and giving the return to the investors as well. So this is the cyclic process for the company to giving return to the investors and getting the money from these investors and running their business this type in this way, right? Secondly, preferred stock. Company can also issue the various type of preference shares, because preferred stocks are considering the preference shares. So company can also giving them the preference shares. It means giving the dividend in return in preference other than equity. If the equity shares also getting the return, no matter, preference shares are also getting the return. But the difference is, if we buy or if any investor buy the preferred stock or the preference shares, it means they get the return at a fixed rate, or they get the dividend at as a preference from the equity shares. So this is also the source of finance for the company. If the company wants to raise, if the company have issuing these shares, then it will also help the company to raising the finance from this type of source. Now coming to the third one, that means IPO. IPO means initial public offer. It means if the company first time issuing their share in the market, or the if any public operation or the public corporation going public by issuing their shares for the first time in the market, in the stock market, then it will be considered as IPO, or the initial public offer for the investors. And this is a very much interestable part for the investors to buying this IPO for the first time, because this will give the higher return to the investors as well. But no matter, this will give the high return to the investor point of view, but after issuing the IPO, company can also get the higher much return from the investors in the part of capital. So this is a major source for the company to raise their finance or to run their operations for the first time or from the starting of the business easily. Coming to the next one, that means private equity. There are a lot of sources as well. That means the private equity. Private equity firms provide capital to the companies in exchange of ownership interest. It means there are a lot of private sources that are also giving the loan, that are also giving the finance to the company to run their operations. So in the form of capital from the private firms, company can also raising the finance from this type of source, which is including the equity financing, and also have a valuable source of finance for the company in the way of return, in the way of cost, in the way of longer period of finance. So you can say that company mostly preferably this type of source for the purpose of raising the finance, for the purpose of running their operations, for the purpose of investment in various projects. So company are choosing these type of securities very much for the purpose of raising the finance. Okay, so this is all about today, friends. Thank you very much for watching this video. Please like, share and subscribe this video more and more. Thank you so much. Have a nice day.